Welcome back. Let's talk markets, where we are headed. Nilesh Shetty from Quantum Advisors is now with us to discuss the market fundamentals. Nilesh, there is no stopping this market, right? Even when we consolidate, we're consolidating with the positive buys. And global markets itself have been doing pretty well. The S&P 500 has had more than 330 plus new highs so far this year. And there hasn't been a big meaningful correction so far. How would you approach the market? What's your view now over the next 3 to 6 months?
With caution. I think, as you rightly said, there is no stopping this market, and rightly so. The earnings cycle, which was depressed from 2014 to 20, has seen a series of upgrades. And so it's not just a pure price earnings expansion. It is a earnings-driven rally as well. And it's not unique to India. Around the world, most markets are going up. So there is surplus liquidity which is driving markets. India has done well because India sort of hit a GDP bottom somewhere around that COVID period. And since then, the GDP sort of been expanding quite rapidly. So there are reasons driving this rally, but the valuations are at a level where you need to be very careful now. At least our advice to investors has been, if you have 100 to invest, you should be investing a third or 50% of that, and not more than that. And then wait for sort of valuations to get a bit more attractive. We don't know what will drive the correction, but we know, and barring pockets of certain sectors in the market, getting companies at attractive valuations is not easy at current market levels.
So Nilesh, is there any pocket in the market where you think valuations are reasonable or at comfortable levels, and at the same time there could be growth in that space so that investors can look at that particular space?
Obvious disconnect between valuations and company fundamentals is in the private sector banks, for sure. They've completely missed the post-COVID rally, and they're slightly higher than where they were before COVID. A couple of them went through their individual issues, where one large private bank had to absorb another one, and one bank had a succession issue. But when you look at the fundamentals and the earnings cycle for the next few years, they are sort of in the best position that they've been in the last decade. And we think they will probably lead the earnings cycle over the next 3-4 years in terms of sectoral contribution to sort of market earnings. So that is the most glaring opportunity. We are getting a bit more optimistic about consumer, but they need to correct more, either through time or price correction. But they've been big laggards over the last 3 years, and rightly so. They were priced at such high valuations relative to underlying earnings growth that is seen correction. And if this continues, we may see some opportunities emerging there. But barring these two pockets, and perhaps a bit more in IT, where they've sort of last 18 months they've been subdued, most of the other sectors are fairly expensive right now.
Power has also been a big area which has generated wealth for investors. Where do you stand on power?
We'll be very cautious there. I think a lot of the businesses, especially the public sector ones, are regulated businesses, and the returns are not meaningfully different than what they were earning 5 years ago. I just think the perception has changed and not necessarily underlying fundamentals for these sectors. I think at these current valuations, they don't make sense if you're a long-term investor, given the earnings growth and the ROE profile of these businesses. So we don't have any allocation there. We have some allocation at the gas utility side, where we think valuations are a bit more reasonable, but thermal power, hydropower, renewable power is just too expensive for us.
You know, I was going to come to you next on the energy space, in the gas and oil sector, because we do keep seeing a lot of updates. There's a possibility that gas could be under GST. Of course, these are again just conversations. In the gas utility space, what is it that you like, and do you think this space will continue to see growth despite the fact that there's a lot of policy changes that continue here?
Yeah, I mean, we own gas transmission companies. That is where we've had allocation, because historically they were the cheapest in the basket to play this theme. They have seen some rally. Again, the volume growth is a given. People sort of barring plus or minus 1-2%. It's the volume growth is never a surprise. It is the view that the regulator takes on the tariff that is always sort of has a sharp reaction to these prices. And there's been varied sort of interpretations of the tariff number. So one company gets a very different tariff and the other company gets much lower. As if the regulatory sort of tariff determination gets a lot more transparent and easier to predict, I think these companies might get a bit more higher valuation than what they're trading at currently. But I think just in terms of where valuations are in that basket, that is a lot more comfortable space, cash transmission companies to play this theme rather than most other oil and gas companies.
Any budget-related opportunities that you're looking out, watching closely?
We're not that shorter-term investors. Our horizon tends to be 5-year plus. But my sense is, given how the election numbers have played out, I think the expectation is that they would do something to address rural income disparity that has emerged. And you see that from FMCG numbers as well, where demand at the bottom of the pyramid has not been growing that well. It's been a K-shaped recovery. So I assume there'll be some policies addressing that. And for short-term traders, perhaps they might want to look at that space where companies looking at the bottom of the pyramid in terms of demand, perhaps they might do a bit better.
Okay, so consumer staples, you're saying someone can look at it from a short-term tactical pre-budget kind of a play. But what about over the longer term? How comfortable are you with the growth versus valuation dynamics of consumer staple companies?
We were not very comfortable 3 years ago. They have seen a meaningful correction last 3 years in terms of time correction and price correction, but still not attractive enough for a value portfolio like ours to buy them right now. We continue to monitor them closely. I'm assuming at some point investor fatigue will set in, where because they've not generated decent returns, you will see investors dumping these stocks where valuations will become very attractive for players like us to enter. But right now, again, they're somewhere in between, not extremely expensive, but not great value as well.
Nilesh, you've been seeking value for a while. You've been cautious in the market. How has the fund performed then? Has it underperformed? Because momentum still seems to be gaining in this market.
So last 3 years has been much better for us. So earlier, you either had to be in a very concentrated portfolio, which did really well, or companies like consumer staples or high-end retail, which did really well. But last few years, because cyclicals have done a lot better, including some of the auto names that we had, our performance has been ahead of the index. It's just that currently where we stand, we are trimming a lot of those positions and cash levels are inching higher for us because they have become expensive. So performance touchwood has been a lot better over the last years than that 2017 to 20 cycle, where GDP growth was slowing down and companies that were growing slightly faster got a big re-rating in valuations, despite them trading at a lot premium than their historical valuations.
And what's the cash position right now?
So today we're closer to 12%. And
okay.
If we get opportunities in some of these select banks where you're trying to build positions, that may come down. But generally, the market were to continue to the way it is, you may see that inching higher.
And would you be okay with increasing your cash level from the current 12%?
Yeah, our highest has been slightly above 30%. So we can move higher if we want.
Okay, all right. So, if you do have that cash at 12%, we spoke about a whole host of sectors. I specifically wanted to ask you about chemicals because that has been the darling of the market for a long time, but not for the last 1 year. Now, there's an indication that maybe recovery could come back. The second half of FY25 is what managements are looking at. Do you think that the trade can be made in these names? First, on the valuations, of course, they still do trade the higher at the 35 to 40 times FY26 earnings. But do you think going forward, growth will support those valuations?
Yeah, I mean, it's a sector we've not been able to figure out that well. It's a sector, I mean, the entire rally we did not participate in, primarily because our sense of what is happening in China, which seems to be a primary driver of company numbers in India and just the earnings number for a lot of these companies is not that great. We don't have, at least our sense of whether companies in China are shutting down, opening up, exporting, not exporting is not that great. So we've been very cautious in that space and we've essentially missed the entire rally. We continue to track them, but like you said, valuations are not attractive enough for a value investor like us to jump into these names saying this is where we think valuations are attractive right now. They still trade at, despite the correction in earnings, they still trade at meaningfully above where we are comfortable at.
You said autos was one of the sectoral holdings which helped you do well in the last 3 years. Do you still hold on to auto? Because, stocks have done well. PE re-rating has also taken place.
We continue to hold on, but we've trimmed a lot. We probably must have trimmed 30 to 40% of our holdings right now. And if they continue to rally, we will continue to trim.
Okay. All right, Nilesh, thank you so much for joining us today. It was a pleasure speaking with you, talking about the markets and a whole host of sectors as well. So that's the word coming in from Quantum Mutual Fund.